Welcome, everybody. This is Edgardo, Balentine.
And this is Scott DiGregorio, and welcome to the Real Estate of Tomorrow podcast, where we're going to discuss the rapidly changing landscape of the real estate industry.
And the steps that you need to take today in order to survive tomorrow.
Look, I'm going to give you the perspective of a 25-year veteran, somebody who has been there and done that.
With Jesus life for all part, okay?
That's for you, man.
Look, I'm going to give you a fresh perspective from somebody that's applying those steps today.
So that basically means you're young and you don't know shit.
All right. Let's get this started. All right, everybody. Welcome to the Real Estate of Tomorrow podcast. This is Edgardo Balentine.
And I'm Scott DiGregorio. What's going on, brother?
What's going on, man?
I am, I'm pumped for this episode.
I'm excited too because this is something that if you do a Google search, if you have been in the market for a little bit, if you are anybody that's a professional in this market, you know that right now there's a very interesting phenomenon happening, which is the rates are going up and the prices are going up, which doesn't fucking make sense, right? Normally you go, hey, rates are down, prices are up, that makes sense. But the rates have been going up now. This is not just 1 month or a couple of months. We've been going up. You know, I read an article that says that the rates have been going up at the fastest rate they have been going up in the last 35 years. Can you translate that in English for our American listeners?
So interest rates have gone up at the fastest pace that they have in the last 35 years.
Los intereses han estado subiendo.
and look, there's, you know, the media loves this, right? The YouTubers love this, right? Because all of a sudden now, this is bringing
housing
fear.
Crash.
Yes,
nobody qualifies. Affordability.
Oh my goodness! And it is so broken. And that's what we're going to talk about today. Okay, we're going to talk about rates in the housing market. We're going to talk about affordability. We're going to talk about what's going on with appreciation. We're going to talk about solutions to higher interest rates without getting real geeky on you from a mortgage thing. And then we're going to talk about just a couple other really good points.
We're going to do all of that, but look. Before some people tune out and all this is not a sales type thing. We're not trying to sell anybody. Look, there's a couple of realities happening and we need to address them, right? Houses are going up at a scary level. Okay?
Absolutely.
Now we have the data to back it up. We understand why, blah, blah, blah. I mean, we did an episode on why the market is not going to crash that I definitely recommend to everybody to listen to that. We did a lot of research for that, and that's something that we're telling all of our clients. But the point is, the reality of the situation right now, and this is why this is so important, because if you just read the headlines, it's very scary. Prices are going up at a very fast pace. Rates are going up at a very fast pace. People can still not find any homes because there's no inventory, and you are basically competing. 1 out of every 6 homes sold in America are bought by an institutional investor. So you're competing not just with cash, but you're competing with cash from Wall Street. So the combination of this creates chaos, and it lends itself to a lot of media and a lot of very scary headlines. So the whole thing that we want to talk about today is rates are going up. Does this mean that the market is going to crash, that we're in a bubble? What do we tell our clients that are concerned about this?
Look, the first thing I think, and this is something we do in our presentations that I think is really critical, go out and find a couple of headlines that sound scary.
That's easy.
That's easy. And then read the articles that aren't scary. Like I saw an article that said, I forget the bill, D.R. Horton or one of the big boys. D.R. Horton is building, is the market in trouble? Major builder builds far fewer houses than expected. And if you read just that headline, it sounds like a major builder has chosen to build fewer houses as a impetus of decreased demand. And if you read the article, what it said was they couldn't get enough lumber and supplies to meet the orders that they had.
Or something super simple as mortgage numbers are 30% low compared to last year. Yes, because refinances are 40% lower than they were last year.
Right. So In your presentation, okay, I talk about this a lot, that nowadays we're such an untrusting society because there's so much BS out there that we need to show and tell, right? We can't just talk anymore. We got to give them data. So for you to have a couple of examples where there's a scary sounding article, but then in the body of the actual article, you can show where it's not scary at all and the implication is not what you think, you automatically discredit all of the naysaying articles that are out there. And now you are properly framing, which we've talked about in the past, properly framing the conversation where it's not like, yeah, but I saw 2,500 people say the opposite of what you're saying. So first you dispel that myth, and then you give them some facts, and again, show and tell. So look, rates have jumped up, sucks. Affordability is more difficult, sucks. But it's not nearly as bad as people think.
Not just that, but the opportunity for people, for the people that can afford homes, it's there, right? And that's something that I think you choose what you focus on, right?
Of course.
You can focus on the fact that right now it's very difficult to get somebody to get, let's say on the lending side of things, to get a down payment assistance program than it was 6 months ago.
Sure.
However, if you are somebody that has the down payment right now, because rents have been going up so much, it hasn't been, that I remember since I've been in the business, it hasn't been as profitable to buy an investment property as it is right now. With the Airbnbs of the world, I told you, I bought a mobile home and I'm making a ton of money on that little mobile home that I didn't even buy as an investment property. I bought it for my parents when they come visit, and it's been my best investment so far. So there's a lot of opportunity in this particular market for the people that can afford it. Now, if we were to break this down in a very surface level, number one, yes, rates are up. One of the main things that are driving rates, and we've talked about this in the past episodes, is inflation. Inflation, like Barry says, Barry Habib, shout out to Barry Habib, is the arch enemy of rates.
Of course.
Right? We're talking about a long-term debt, which means that if I'm gonna give you, Scott, $100 a month, or if I'm gonna give you $100 or $100,000, sorry, and you're gonna pay me, you're gonna give me in return $100 every single month for 30 years, it's very important for me to study, okay, what is this $100 going to be able to buy me in not just 1 year or 2 years, but in 10 years? And if I see that inflation is going up, that inflation is extremely high, and those $100 will not be able to fill my tank when it comes to
it's buying you $70 worth of goods.
Then what I do is I increase the rates. So that's a reality. We expect that to continue to happen in the short term. Now, again, go and listen to the episode that we did before. We expect a recession to happen later on, and rates to go back down, even below 3s, and we're all gonna be singing Kumbaya, and we're gonna make an episode that says we were right. And in that episode, we're gonna have a little snip of me saying this right now. Now, so that's as far as rates. Now, talk to me about appreciation and houses, because if I just look at this and I just think about this, well, if rates are going up, then that means that if I'm trying to sell my home, this makes sense, right? If I'm trying to sell my home and rates are now from 2.5 to, let's say, 5.5, the person that qualified for my home at 2.5 now doesn't qualify for my home, so I need to lower my price to their level. So let's say if my house is $500,000 and at 2.5 they qualify, and now it's 5.5, I need to lower it, and I'm making up this number, I need to lower it to 450 instead of 500. Tell me.
In a balanced market, you're 100% correct. And typically, there's two pieces of that I want to touch on. I could talk for that. We could both talk on that for an hour, but to keep it succinct. Number one, there is a ton, okay? I think the latest statistic I heard was like 28% of all homes in America, and Ed, where you and I live in Southwest Florida, it's over 50% of homes are paid for in cash. So that's the first thing. You mentioned earlier 1 in 6 homes are being bought by Wall Street. Interest rates have no factor on that. So that's a pretty large segment of the market that kind of doesn't matter. So that's the first thing. The second thing is this. although those two things often work in conjunction, and I mentioned that they work in conjunction in a balanced market, it's worthy of note that what's driving the appreciation of homes now is nothing other than supply and demand.
Okay, you gotta repeat that, because the problem with that is so simple. It's so basic that I think it's getting lost in people. People are doing the high level mathematics and the high level thing of thinking, well, this happened 10 years ago, so this must be happening right now. I've heard of lenders doing bank statement loans, so back in the day they did things like this, and they are forgetting the simple, basic economic principle of supply and demand.
Yes.
Which is the first thing that you learn when it comes to economics.
It is the premise of economics.
There is no inventory right now, and when there's no inventory and there's there's 100 people trying to bid for one home, what that does is that increases the price of that one home. And the thing is, in order to build back inventory, it takes a lot of time. It takes years, okay? And this is not a problem that just happened last year. This is something that was happening for years and years and years, but COVID accelerated this. So
Absolutely.
Right now, all the builders are more than willing to build all the homes to supply for all the inventory. But there's no materials. You can't find chips. It takes forever to build a house.
Labor shortages.
There's no labor. So this is something that not only we have an issue right now, but it's an issue that we can't just throw a Band-Aid at. It's going to take years to recover from this.
Yeah, and let me give everybody some data points, because these things sound a lot better when we're talking to our customers when we have data points, okay? The 50-year average of how many homes are being built per year in America is 1.5 million units a year. We have been below that number for 13 consecutive years. For the last 13 years, we have been building around 1 million homes a year. So this 500,000 home shortage has been starting to grow. We are currently, according to the latest report by NAR, we currently have a shortage of 5.5 million homes in America. If builders typically build homes at a million units a year, that's 5.5 years. But like you said, Ed, there's nothing typical about what's going on now. So we're in this for years. Now, do things loosen up and we get out of it in 4 years? Do things not loosen up and we get out of it in 7? I have no idea. Nobody can predict, certainly not out that far. But to think we're going to get out of this in 6 months, it's just math that we're not going to.
A healthy market has a 6-month inventory, right? That's what we've all learned in real estate school. 6 months means if there's no more new homes for sale, it's going to take about 6 months to be able to run out of inventory. Right now in America, we are below 2 months of inventory. Mm-hmm. Now, again, this is in America. We're talking about all over the country. If you are in an area like we're in, where there's a lot of people that are retiring, where there's low taxes, there's people that are coming from high tax state to come live here, especially in this post-COVID world where you can work from anywhere, well, that's gonna be even worse. So again, rates are up, that's a reality. However, that's not affecting appreciation because there's no inventory. So even though a lot of people are priced out of the market, the people that are in the market that can afford this market are way more than the houses that are available to them. So, bro, okay, that's an issue. What are the solutions that we can provide to our clients as realtors, as lenders, as anybody in the real estate industry?
Look, I think the first solution is a check on your perspective, okay? In two areas, okay? We're talking about rates, so we got to get into the mortgage weeds a little bit. Number one, we need a historical perspective on rates. If you Google Freddie Mac historical mortgage rates, it will have a year-by-year breakdown of rates. I believe it goes back to 1971. And you will see that up until the crash, never in history have interest rates been below 6%. Ever.
I think the average is like 7.8%.
Yeah, it's just under 8%. So now granted, for the last 10, 12 years, we've been living in la la land and rates were in the 2s and 3s, but I show that chart to my customers every single time. And I realize you guys don't do mortgages, but you should as well, because the people you're talking to are thinking to themselves, some of them, I am not going to buy a house until rates come back down. So if you show them that over the last 50 years, rates have always been higher than they are now, that's going to shift things. Okay. The second thing is, and the second thing, I'll leave that point to the end that I was going to make, but the second thing is there are good mortgage solutions to higher interest rates in the form of adjustable rate mortgages.
Okay, stop there for a second. Let me just say the third thing right away before we even finish with the second thing. And it's, look, guys, a lot of times because we focus so much on the issues that we have, we don't look at opportunities. So, for example, if you are somebody that can afford a house right now, there's a lot of great opportunities because, again, if 1 out of every 6 homes bought in America are bought by institutional investors, it's because they're making a good ROI on those homes.
It's a solid point.
So now is a good time.
Black
to
Knight knows what
invest.
they're doing.
Yeah, exactly. Now is a good time to invest in properties, even though it feels like the investment is expensive. Well, if your return on investment is still high, it's not an expensive investment. Number 2, a lot of times because we're used to how things used to be, and what's the name of this podcast?
Real estate of tomorrow.
Not today or not yesterday for sure. Because we're so used of how things used to be, we miss opportunities that are in our faces right now. And let me tell you, because I haven't been in the business for 75 years like you, I have always told people, never get an adjustable rate mortgage. It's always a fixed rate because they're dangerous. While that might be true, they're dangerous, they're also very advantageous. It's a good word. You like that, right?
I do.
Just like an investment. An investment might be very dangerous. A credit card might be very dangerous, but you can actually take advantage of that. So right now, for example, and not to, get too in the weeds, like you say, if I am able to provide one of my clients or my clients an adjustable rate mortgage that's 2%, like 2 full points lower than a regular 30-year fix, and we expect those rates to go down at some point in the next 5 years, man, what a great opportunity it is for them to be able to get into a home, take advantage of the investment opportunities of this home, and save on 2 points on that mortgage.
Now, let me push back on something you said, because
You've been pushing back a lot lately, man. Come on.
Your youth had shown through in something you said. An adjustable rate mortgage is not inherently dangerous. The adjustable rate mortgages in 2006 were, because they were insanely written. A conventional Fannie Mae, Freddie Mac adjustable rate mortgage that's fixed for maybe 5 years or 7 years or 10 years can adjust. But with the way the economy is, I had people come to me with adjustable rate mortgages that they got back during like pre-crash, and they'd come to me for a refi, and I'm like, your current interest rate is 1.3%. So the loans have to be written responsibly. And look, this is where the competence of a loan officer comes in. Okay, if you got somebody that the mortgage payment is strapping them, and there's an opportunity for it to go up, you can't do that. That's bad. But I'll do analysis with people. And I'll say, hey, I did one where the fixed rate mortgage was 5.375, the ARM was 3.375, the difference in payments was $800 a month. And I showed the client how if you took that $800 and invested it, how much money it could turn into during the time. So look,
or we're just talking about that, right? I did something extremely similar, and I showed the client how if they put that extra $800 a month into the principal of the house, how much faster they're gonna end up paying that house and how much they save in interest. But those are the conversations.
Exactly. And I have clients coming to me saying, my real estate agent told me to never do an adjustable rate mortgage. And we need to, and this is the third point, we need to have a positive outlook on this and an open mindset. Now, if you're sitting there and you think that's cool. Get with your lending partner and get the answers to those questions. And by the way, if your lending partner can't answer those questions, you might want to find other lending partners, because when rates are 2 and 3%, getting an adjustable rate mortgage is a nonsensical, ridiculous thing. But in an interest rate market of 5s or 6s, now all of a sudden adjustable rate mortgages make tons of sense for people, especially considering everybody we're closing on now, we're telling them in 12 to 24 months, we're going to refinance you down into a low fixed rate mortgage. So this is a short-term thing. And we need to be part of the solution, not part of the fear-mongering. There's plenty of people doing that for us.
And look, sometimes, like you just said, it might not be for you. It might not be for your clients, and you have to have the courage to say, look, the truth is, this is not right for you. But again, if you look at the statistics and you see what's happening, right? If you see what's happening with the rates going up, but appreciation going up, and you have somebody that, and again, the statistic of 1 out of every 6 homes by an institutional investor that's buying it to rent the property or to, to put the property for rent, the rents are going up at an even higher pace than the rates, and the prices are going up. When you put all of that together and you talk to somebody that's renting a property, I understand that as a rule of thumb, you don't feel like an adjustable rate mortgage. It's a good thing because it adjusts, let's say, every year.
After the initial period.
Scott, when you are renting a place, let's say that you own the place, but you're renting it. Is that considered an adjustable rate mortgage? Because your rent adjusts every year, doesn't it?
So you're saying that rents go up all the time too, and that's actually not much different.
No, and you don't sign a contract for the most part to say that your rent cannot go up for the next 5 years or for the next 10 years. Basically, you're open that every single year your landlord can kick you out, worst case scenario, or increase the rent, which is what we're seeing right now. So a lot of times you got to look at the alternative. Yes, getting a fixed rate at a 2.5 is much better than getting an adjustable rate mortgage at a 3.8. However, renting a house is much worse than getting an adjustable rate mortgage at a 3.8. And that's what we need to focus on. When Scott says we gotta be positive, it doesn't mean let's, it's sugar and rainbows and let's be happy and kumbaya and hee ha ha. Look, it's not as good as it was yesterday, but it sure beats renting and getting your rent higher every single year, as opposed to locking in today's prices for the next 5 or 10 years.
Look, think of the people that you've spoken to, because we've had plenty of these conversations in 2020 and 2021, who said the market's too hot, I'm going to wait a little bit before I could buy for things to cool off and turn around. How's that working out for people? So look, the truth is this, okay? When rates are super low and there's plenty of houses available and house prices are going up, yeah, it's really easy to be in real estate or finance. No question about it. Markets like this is when we need to sharpen our pencil and get better, and frankly, better earn our income, right? It has to actually be earned these days, and getting knowledgeable in this. And you might be thinking to yourself, hey, this is mortgage stuff. This has nothing to do with me. It's not my job. That's an incorrect mindset, because here's the thing. If the person's not financially, as you say it all the time, right? People see a house visually, fall in love with it emotionally, but the ultimate decision to buy a house is a financial one. So if these things are not being addressed, you're not going to get past the first conversation, or you're not going to get to the first conversation, because if you take all this stuff and put it out there in the form of podcasts and Facebook Lives and Reels and Instagram posts and the stuff that you and I do, Ed, all of a sudden now you're going to have people knocking on your door going, hey, wait, I want to pick your brains about that. And now that becomes an effective solution.
Look, and
the marketing plan.
If you're thinking, look, I deal with cash buyers and that's it, and so this doesn't affect me, think twice, because this affects the overall market, right? And even though you might deal with a cash buyer and the buyer itself, it's thinking about buying cash, that doesn't mean that they're unaware of the fact that the rates are going up. And look, I talk to clients that are going to pay cash. They still want to pay cash, but they talk to me because they're afraid that because the rates are going up, the market might crash, and that's the belief that they have in their mindset. And they just want to talk to me because they want to pick my brain on that. They say, "Hey, I'm going to pay cash. I don't need a mortgage. I don't want a mortgage." However, I'm very concerned of what your thought is on the fact that the rates are going up. Will that affect the market? And these assets that I'm buying at $500,000 will cost $300,000 in 2 years. So even if this doesn't affect your current buyer as your current buyer being able to qualify, it is something that's important being knowledgeable about and addressing, because it might not affect their ability to purchase, but it might affect their conviction that this is a good investment.
Yeah, and we say it all the time. Are you interested in buying a house, we ask our clients, or are you committed to buying a house? Because this is a market that requires commitment. So
yeah, if you don't walk with a buyer that's not only committed, but it's excited and has no fears to buy a house right now, they're gonna lose the bid, because they need to be more than committed. They need to be excited to put that offer.
And you and your lender need to work together as a group, as a team, to create that excitement and provide that education and get the client where they need to be mentally, because otherwise you're just spinning your wheels.
So that's it, guys. Rates are up, prices are up, and the opportunity is out there. And this is not how things normally go, but this is the market that we're in right now. And if you have the knowledge, you will have the advantage. So the question that we always ask is,
are you doing what you need to do today to be successful in the real estate of tomorrow? See you in 2 weeks, everybody.
Give us 5 stars. Just give us 5 stars. Well, thank you guys for listening. And now it's your turn to implement everything you learned today.
Look, you have a question, you have a topic for a future episode?
Share with us.
Yeah, tell us what you're doing. What are you doing today so you could be successful tomorrow? Send us an email at success@realestateoftomorrow.com.
And don't forget to leave us a review, an honest review.
Screw an honest review. Leave us a 5-star review. And for every 5-star review we get, we're going to send you a badass real estate meme t-shirt.
Those shirts are hilarious.
See ya.